2016 has been a year of currency fluctuations driven by political uncertainty and euphoria, threats of protectionism and various government manipulations as well. We've witnessed the US dollar surge to levels not seen since 2002. A Chinese yuan is set to have its biggest annual loss since 1994. Sterling plunged to a 30-year low at one point, and the Japanese yen also enjoyed some losses thanks to impressive gains of the dollar. So it's also interconnected, isn't it? We've got Kit Dukes here from SocGen to tell us all about it and how these currencies affect the global stage, if you like. It's been quite a year, hasn't it, for the currencies?
It's been an interesting year. I mean, a sort of year of two halves. There's a cliche for you for things like the yen, which, you know, spent the first half of the year getting stronger and the last third of the year getting weaker, and is roughly back where it started now, weirdly. The pound's the big loser of the major currencies. Brexit, you know, was a surprise, but the economy's slowed, interest rates have come down, and that's taken us a long way. The dollar started the year really strongly, spent a lot of the year not going up, and then obviously since the presidential election we are in full Trump mania, and that's going to be a theme for the start of next year. So there's a lot of themes, and then the very strongest currencies in the world, the Brazilian real and the Russian ruble, both reflect the recovery in oil prices in the second half of the year. So yeah, quite a lot of different strands coming into Christmas, some of which will survive into the first half of next year and some maybe a bit longer. Okay,
well, let's talk about that then. Do you think the US dollar has a way to go then just yet? Because obviously Trump hasn't even come into power.
Yeah, my kind of guess is that I'm in for the dollar rally for the first 99 days of Trump. So if he's supposed to have a 100-day program from January the 20th when he takes office, then 99 days in, oddly, takes us, I think, to the Friday before the first round of the French presidential elections, and I think but that'll do me. There's part of me that thinks I'll probably, I'd like to sell out my dollars at higher levels against lots of things round about then.
Okay, and obviously you mentioned sterling as well. Well, next year is a huge year for Britain because Article 50 will ignite. How do you think sterling will respond to that one?
Yeah, I think it's going to be less exciting for sterling than it was this year, in the sense that, I mean, I would say French politics is almost a bigger deal than British politics. In other words, assuming we trigger Article 50 at the end of the first quarter, assuming, I'm not sure you can assume much, you know, the economy is going to grow more slowly, but it's going to grow, and I'm not quite sure where expectations are. I don't think we'll get any change in monetary policy through the year. But the big thing for me is, I mean, if you imagine, for example, if for example, the National Front candidate Marine Le Pen were to win the French elections, I don't know that the negotiations about immigration control, for example, on the UK, would be the same if she were on the other side of the table from what they would be if François Fillon, the other most likely candidate according to opinion polls, wins. So that how Brexit plays out depends on the French elections quickly, the German elections later, and even up to a degree on the Italian elections right at the end of the year. So it's all sort of jumbled together. I think the pound will probably trade down against the euro in the first half of the year and up against the euro, up against euro in the first half of the year and down against the euro from kind of spring onwards. So I think
politics will dictate.
Will dictate, I think, unless we get, and then we're going to be waiting and seeing, you know, whether we do get economic surprises. We've kind of settled into this sort of situation where we're sort of relaxed about the uncertainty, or less worried about the uncertainty than we were.
We've got used to it now.
Can you get used to uncertainty? But yes, we have, and so the surprises will come from, you know, how much the economy does slow down. I mean, it will slow down, but how much? And I'm not sure at what point we become complacent and vulnerable. Okay,
and let's head into Asia then, back into Asia. China's been a big theme. Obviously, their yuan has fallen tremendously. They want that, right?
Yeah, it's a 7% fall. I mean, you know, if you looked at it in real terms going back a decade or so, it's given back less than half of what it made in the previous few years in real terms. So it's got a lot further to fall relative to other currencies to get itself more competitive. I'm not sure it's going to be allowed to fall all of that way. But what's really changed in that sense, though, is that whereas, if you like, 10 years ago, they were running a surplus on their trade and current account balances, and they were seeing huge inflows of capital to take advantage of their growth. Now, money's trying to leave the country. They're working quite hard to slow the pace at which money leaves the country, but they're shedding foreign exchange reserves very quickly. that there's a sort of a growing sense within China that maybe we should, keep our foreign exchange reserves from falling below $3 trillion as a buffer against crises in the future, and let the currency weaken through 7 yuan to the US dollar and just let it weaken faster. Not sure if weakening it faster would stop the capital outflows. That's the bit I'm
and with China, there's the Trump factor as well in terms of trade.
There's the Trump factor. So it could all get ugly if we get some kind of trade war. And in a sense, that means that for now, what they're doing is, let's keep the currency just gently weakening before he turns up, because it might all get more difficult afterwards. But it's going to be an interesting conversation. He thinks they're manipulating, or has said he thinks they're manipulating the market to keep their currency weaker than it would otherwise be. If they step away from the market, it'll get quite a lot weaker, quite a lot quicker. So not quite sure how that plays out at all.
And stealing American jobs as well. Lastly as well, I want to talk about the yen too, because that's been a big theme. Actually, for Japan, it's gone their way.
It's brilliant. I mean, in the sense of that the policy decision at the end of January to go into negative rates, a surprise decision no one was expecting, hadn't been much discussed by all accounts within the sort of strategy department of the Bank of Japan. Split vote Friday afternoon. I wrote a piece about it in a bar in Seoul in Korea afterwards. I was so angry. I thought this was a ridiculous thing to do. That backfired. We're trying to get Japanese investors to buy more foreign assets at a time when Japanese investors were very long foreign assets whose prices were going down very quickly. And then in September, by anchoring 10-year interest rates at a time when the global bond market was selling off and bond yields were going up, they hit upon exactly the right policy to weaken their currency in the current climate, and away we go. I think they can probably get 5% more, 10% stretch. At some point it gets so cheap that I don't know how much you can push it, but for now, it's helped the equity market. It's helped confidence. It's all going swimmingly for the Japanese. As a trader, I wouldn't want to push my luck too far through 2017. But as long as it lasts, up goes the Nikkei. Everybody's happy.
Yeah, they could have done with that at long last. Kit Dukes, thank you very much indeed. Talking to us today from SocGen about the currencies and what to expect in 2017.